Hello and welcome. You're watching ET Markets. I'm Tanya Aneja. Well, the first 5 months have been nothing short of a roller coaster ride for all the investors on Dalal Street. So, looking at the current market scenario, it's important to ensure that your investments are parked in the best stocks. And it's also very important to learn the art of picking stocks in a falling market. Well, to spill all the secrets, I'm going to be joined by a very special guest today. Well, we have with us Pranjal Kamra, founder of Finology Ventures. Thank you so much, Pranjal, for joining us on ET Markets again.
Thank you so much for inviting me. Always a pleasure.
So, Pranjal, for all the equity lovers, what would be your advice? I mean, what are the factors that one should look at before investing in a stock? And also, there are plenty of stocks now trading at double-digit discounts compared to their 52-week highs. So what is the right strategy to be followed, especially when buying a falling knife?
Right. One thing before getting into stock selection in such a scenario, we need to be really careful of is that, a lot of stocks look optically cheaper. They might not be fundamentally cheaper, but because market was somewhere else a quarter ago, 6 months ago, and you find that, the stock on your watch list is now 40% down, 50% down. So optically, it looks cheaper. But, just to give you an example, if, something that has an MRP of 1 lakh rupees, say an iPhone, and it was selling for 2 lakh rupees for 6 months, if it falls back to 1,50,000, it's still 50% more than the MRP. It's not cheap. It's comparatively cheap, but not intrinsically cheap. So one thing, people who have entered in the last 2 years, they've always seen prices go up and up. And now they think that, this is the time to get bargains, which is where, they need to be really careful. There are a lot of stocks still are intrinsically not cheap, only optically cheap. Having said that, in a market like this, how do you start, picking, which ones to buy and which ones not to buy? One golden rule in such a scenario is to look for value stocks and not growth stocks. Because what happens is, first, every 2 years, there is a theme. Stocks operating under those particular themes, they tend to go, rise higher. But in a scenario where there is correction happening, it's very difficult to predict which the next two themes will be, which will do really well. And thereby, you don't want to be caught in the wrong theme, because stocks which were growth stocks in 2020, 2021 and were identified and labeled as growth stocks will not be again labeled as growth stocks. Definitely some other industries will be labeled. So you don't want to buy previous 2 years growth stocks now, because they might not be growth stocks coming down the line. So which is why it's important that you pick stocks which have this scope of PE expansion. You buy stocks so cheap that, even if your theme selection goes wrong, simply because you bought it at a bargain, you get a decent return.
Absolutely. So that was all about the art of picking the right stock. And also, Pranjal, every investor wishes to own multi-baggers in his or her portfolio, but it is not an easy task to find such stocks. So how should one pick long-term wealth creators?
So I think I've always believed that multi-baggers are only in hindsight. You can never predict multi-baggers. What happens is that, if with discipline, you have a portfolio of 15 to 20 stocks, invariably, some of them turn out to be multi-baggers. But that's because your process worked. Even if, say we take an example of a cricket team, there are 7 batsmen. You pick 6 or 7 good batsmen, but you cannot say that in which match, which one will perform. That's why you have 7 players. If you knew who are the 2 who will score centuries, you wouldn't pick the other 5. It happens with stocks as well. You collect a bunch of good players, a good bunch of good stocks, and then you don't know. You don't pick favorites among them. Once your team of 15 to 20 stocks is ready, you are not biased towards them. You cannot, point out those 2 stocks that these will be my heroes. It doesn't work that way. So, and again, it's very important to stick to controllables and avoid the uncontrollables. Which stock price will, go where? That's out of our control. So don't worry about that. What's in our control is picking good 15 stocks and then staying with it. Staying with it and good picking, these 2 things in our control, stick to that.
Absolutely. And also, Pranjal, if someone is planning to put 10 lakh rupees, let's say, which is the ideal medium according to you right now? And what would be the ideal asset allocation strategy?
Right. So this is a very, I mean, this would change from person to person. Risk profile, needs, goals, also the amount of time they can stay invested. But there are a couple of, risk profile agnostic instruments I always recommend and which I feel are still ignored to an extent. One is sovereign gold bond. Absolutely, almost any person with any kind of risk profile, depend any kind of profile, sovereign gold bond is one instrument which is really a boon in this country, and it's disheartening to see at times that how often it's ignored because it's an instrument promoted by the government. So a lot of intermediaries don't get anything by promoting it. Stakes of intermediaries are not involved, which is why it's not promoted enough. But that's one instrument that gives you capital appreciation of gold, close to 10%, 11%. Gold has given returns over the last 80 years. So and on top of that, it gives you 2.5% of interest. So capital appreciation of gold and interest rates of savings accounts. So that makes it 13 to 14%, similar to what mutual funds offer. If you hold till redemption, there's no income tax on it. Mutual funds now have income tax. So 13 to 14% tax-free returns. On top of that, if you don't buy when it's issued by the government, if you don't buy the new issue and you actually buy it, so this is an interesting hack. If you buy a sovereign gold bond through stock market, usually you get 5 to 10% of discount on the gold price. So if gold price is at 50,000, you will usually find sovereign gold bonds trading between 47 to 48,000. So you're buying gold at a 10%, 5 to 10% discount. And then you're getting 2.5% extra per year. All of that is tax free. So this is one instrument, regardless of your risk profile, everyone should absolutely definitely have. The second is, when it comes to investing or insurance products, a lot of banking, financial and investment products, we are attracted to fancy and innovative instruments. Whereas the thumb rule is the most boring instrument is usually the best. So, specifically coming to mutual funds now, which is the most boring mutual fund scheme you could think of? Probably large cap index fund. You are basically writing an undertaking that I guarantee myself that I will never outperform the market. Sounds really boring, writing it down for you that you will never outperform the market. But the reality is 70 to 80% of funds that promise to outperform the market actually underperform it. So by signing that agreement, you are ensuring that you will be defeating 80% of those active funds. It's really boring, to say to yourself that I'll never outperform the market. When you meet your friends, your family members, to tell them that I'm invested in an index fund, and the first thing they'll tell you is that oh, why are you investing in an index fund? I have these stock tips, these mutual funds that can give you better returns. But the thumb rule is the more boring the instrument, the better it is in general. So index fund, again, I think a lot of people miss out on that. They think it's too conservative, not for them. But again, it's for almost everyone.
Absolutely. All right. And also, how does one deal with this kind of a situation where one know that whatever you have invested in the last couple of months have not given you returns, and even fixed deposits are giving you better returns? I mean, while it is important to stay invested in this market, but should one also be mentally prepared that the fall is not over yet?
Oh yes. I mean, first rule is you only invest the amount that you can stay invested for 5 years. Equities or mutual funds, it cannot be 2 years, 3 years, minimum 5 years. 5 to 7 years is a period where one down cycle and one up cycle is complete. So 5 years is the bare minimum. Having said that, I understand that if someone has invested even with the mindset of staying for 5 years, and you invested 1 lakh rupees and you see that it's 80,000, 85,000, it pinches. Most middle class people, they save by compromising on the luxuries, the dinner experience with their kids and things like that. So it pinches. But we have to understand that this is the nature of the stock market. If you cannot digest volatility, then the upside that it offers, you won't be getting it in the long run. In fact, this data could help. So I was just going through mutual fund performances over the last 12 years. Even the worst performing equity mutual fund scheme. So if you had the worst advisor in the world and he suggested you the worst equity scheme, the return offered by that scheme, if someone would have invested for 10 years, was 9.5%. Even the best FD in India does not offer 9.5%. So in the long run, mutual fund is a 99% insurance that you will defeat the FDs by at least 50%. It's basically insurance. But it's the mindset thing that because of the fact that NAVs are declared every day and stock prices are shown to us every second, we are worried about it. I bet if land prices in your city, in my city, had an index, and every day in the newspaper we had property quotes ki Andheri property price fall by 1,000 rupees square feet, Bandra it rises, people would start trading in property as well, just because that information is there. The fact is, land is not that liquid. The transparency in minute by minute prices are not there, is the only reason we don't worry, even if we hear that our neighbor sold the property at 5 lakh rupees discount than what it was 1 year ago. We don't panic because we understand that property prices fluctuate. But stocks, simply because we have a minute by minute index and mutual funds day by day index, is why we panic. So if we think of stocks and mutual funds as property, we wouldn't be worried about these falls.
Absolutely. Golden words coming in from you. On that wonderful note, Pranjal, thank you so much for taking the time out, sharing your valuable thoughts and being with us here on ET Markets today. Thank you so much.